work today, and I'm very much looking forward to the discussion and to the questions. So this is joint work with Thomas Torsler from the Danish Ministry of Finance and Ludwig Weir, who's finishing a postdoc at UC Berkeley. The starting point of this research is we ask the following question: how much profits move across countries because of differences in corporate income tax rates? So there are two ways that firms can move profits across countries. One is that multinational companies can move capital, factories, headquarters to low tax countries. And the second is that firms can shift paper profits, so they can keep producing stuff in the US, let's say, or in Germany and Japan, but they can book earnings for tax purposes in low or zero tax places like Bermuda or like Ireland. A very famous case is the case of Google Alphabet. In 2018, Alphabet booked close to $20 billion in earnings in Bermuda, a small island in the middle of the Atlantic, where the corporate income tax rate is a relatively modest tax rate of 0%. And so the question we ask is, okay, if there was a perfect international tax coordination, imagine that all countries tomorrow jointly decided to define profits in the same way, so same tax base, and to apply exactly the same tax rate. Okay, so if there was such a perfect international tax coordination, how would the world look like? And in particular, which countries would gain or lose profits compared to today's situation? So would we see much more profits booked in the US? How much exactly? How much more exactly? And how much less profits would be recorded in places like Ireland or like Bermuda? And second, these profits reallocation, would they be because of a relocation of tangible capital? So would we see factories moving back to the US? Or would this be because of reduced profit shifting? So not a lot of movement in tangible capital, but more paper profits being recorded in the US or Japan or Germany, and less in tax havens. So that's the question we try to address in that research. And let me emphasize at the beginning that we certainly don't have definitive, perfect answers to these important but complicated questions. The point of the paper is to make some, little bit of progress towards addressing these questions, towards more broadly addressing some of the macro distributional implications of globalization. And we're doing this by using new data that has become available recently. And these new data are what is known as foreign affiliates statistics. So as you know, what exists today, what has existed for a long time, for several decades, in terms of macroeconomic statistics, is national accounts data. The national accounts data of the US tell you how much wages, the amount of wages paid by US corporations, profits made by US corporations, their value added, and so on. Same for the national accounts of Germany. What has become available recently is statistics that decompose the corporate sector of each country into two groups: local firms versus foreign controlled firms, what's called foreign controlled enterprises here, and that screenshot of Eurostat data, meaning firms that are subsidiaries of foreign multinationals. So now with these foreign affiliate statistics, we can know the amount of wages paid by German firms that are affiliates of foreign multinationals. We can know the amount of profits booked by German firms that are affiliates of foreign multinationals. And as a residual, we can have statistics on value-added wages and profits for local German firms that are not part of a multinational group. And what's really important is now that these statistics are available for some of the key tax havens. So they're available for Ireland, for Netherlands, for Switzerland for a number of prominent OECD and non-OECD tax havens. So now, for instance, for Ireland, we can know how much profit and wages and value added is made by affiliates of foreign multinationals that operate in Ireland versus local Irish firms. And so using this new data, we provide a first global map of where multinational corporations book their profits today. More precisely, the computation that we are going to make is a very simple computation. So here is how we estimate the amount of profits shifted to tax havens. The main computation in the paper is that we're going to compute labor and capital shares of value added for each country separately for foreign firms and for local firms, okay? So previously we could know, the labor share and the capital share for Ireland as a whole or for Germany as a whole. Now what we do in this paper is we compute the capital share of foreign firms in Ireland, affiliates of foreign multinationals that operate in Ireland versus local Irish firms. Same thing for firms in Germany. We can compute the capital share for German firms that are affiliates of foreign multinational groups versus German firms that are not part of a multinational company. And what we see when we do this computation is a striking global pattern. So generally speaking, throughout the world, we find that foreign firms, so firms that are affiliates of foreign multinationals, have a lower capital share than local firms, with one big exception, which is tax havens. So in tax havens, foreign firms have a much higher capital share than local firms. Okay, so to take one example, again, in Germany, foreign firms have a lower capital share than local firms, but in Ireland, it's the opposite. Foreign firms have a much higher capital share than local Irish firms. Our benchmark estimate of the amount of profits that are shifted to tax havens globally is going to be very simple. We're going to say, if there was a perfect international tax coordination, the capital share within each country, the capital share of local firms would be the same as the capital share of foreign firms. Or to put it differently, all the excess profitability of foreign firms in tax havens relative to local firms in tax havens reflects profit shifting to tax havens. And I'm going to discuss, the assumptions that we need to make for this estimation strategy to deliver an accurate estimate of profit shifting. And so this relies on a number of assumptions, but the advantage of this methodology is that it's very transparent. Anyone can compute this statistic. This is something that can be computed by international organizations, for instance. And as we're going to see, this is also the amount of profits shifted to tax havens that we're going to find is going to be robust to relaxing some of the key assumptions. Okay, so at that stage, we have an estimate of the amount of profits shifted to tax havens globally. The second stage is we are going to allocate these profits to the countries where they would presumably be booked if there was this perfect international tax coordination that I was mentioning at the beginning. So who are the countries that are losing profits today compared to this benchmark of perfect tax coordination? And to do that computation, we're going to use a second new data set, which is the bilateral balances of payments that have been recently released by most economies, and in particular, the bilateral service trade data that have become available in recent years. So here is the services exported by Ireland in 2014. So we see that Ireland exports a lot of information and communication technology services, ICT. It exports medicaments, it exports, blood, apparently. It exports all sorts of things. So that was known for a long time. What's new now is that we know the countries to which Ireland is exporting these services. And we're going to follow the destination of these exports to allocate the shifted profits to the countries where they have been made in the first place. More precisely, in our benchmark allocation of the shifting profits, we are going to follow the destination of tax havens, service exports, and intra-group receipts of interest. For services, we're going to focus on the types of service exports that have been found in the literature to be particularly conducive of profit shifting. So when companies in Ireland export management services, export the right to use intellectual property, export some types of financial services, export sometimes of information and communication technology services, all these exports, they increase the tax base in Ireland, they reduce the tax base in the destination country, whether it's the US, whether it's France, whether it's Germany. And so by following the destination of these exports, we can try to identify where the profits, from where the profits shifted to Ireland originate. The outcome of this is that we have granular estimates of profit shifting at the bilateral level. That is, the outcome of this research is we have estimate of how much profits are shifted out of France to Ireland, out of Germany to Switzerland, and so on. We've collected these estimates in a new global database that makes it possible to study some of the redistributive effects of globalization. And that's a database that we are updating annually, which makes it possible, and which hopefully in the future will make it possible to study the effect of a number of policies that have been implemented in recent years to curb profit shifting. So this database is available online with all the computer code, all the data, all the raw sources on missingprofits.world. So that's a map here, and for each country, the map reports our estimate of how much profits have been shifted out of that country or shifted inwards, in the case of tax havens, and the bilateral estimates that I was describing, and our estimates of the tax revenue losses, the corporate tax revenue losses that are caused by profit shifting. So if you click, for instance, on that map on Spain, here's what you get. You have our estimate of how much Spain loses in terms of corporate income tax revenues, about 13% of what's currently collected by Spain, and an estimate of how much profits are shifted out of Spain to tax havens, about 15 billion euros, and the countries to which these profits are shifted. So in the case of Spain, that's about 4.5 billion shifted to the Netherlands, about 3.5 billion shifted to Luxembourg. There's also close to 3 billion euros shifted to non-EU tax havens. And in each case, the amount of corporate income tax revenues that we estimate are being lost by a country like Spain because of this profit shifting. Okay. All right, so next.
Yeah, so Gabriel, let me interrupt to ask a question on behalf of Brian Eamon. Are you able to look at worldwide capital shares of these firms? For instance, if you see a firm that has an unusually high capital share in Ireland, can you see if they have an unusually low capital share in the US at the firm level?
Yeah, no, that's a great question. And we don't have firm level data. So we only have data that's aggregated at the country level. So for Ireland, we have an aggregate of the profits made by foreign firms in Ireland. We know where these firms are headquartered typically, so most of them are headquartered in the US, but that's all we have. We don't have firm level data, and so we cannot link a specific subsidiary in Ireland to a specific parent in the US, which would be extremely interesting to do, which in the case of US multinationals, you can actually do using the micro data that underpin these macro statistics. These micro data are collected by the Bureau of Economic Analysis and are made available to researchers. So it's something that can be done for the case of US multinationals. Some countries are also starting to make available the underlying micro data. So that's the case in Germany, for instance. but most countries, in my experience, don't make available the microdata, but they do publish the tabulations, the aggregate statistics. And so what we do in this research is we only use the aggregate statistics, but we use all the aggregate statistics from all countries with systematic imputation methods when aggregate data are not yet published. And in the next stage, it would be extremely interesting to try to use the microdata from all countries in a systematic manner, which will make it possible to do the computation that you're describing, for a given firm to look at its capital share, the capital share of its affiliates in low tax places versus the capital share of the parents. So that's for the future. All right. Any other question? For some reason, I can't see the Q&A.
Yeah, you're good to go. We cleared the Q&A so far.
Okay, great. Great. So if I try to summarize the main results, here's what we have. We find that about 40% of multinational profits are shifted to tax havens each year. So 40%, what is multinational? What do we mean by multinational profits? Multinational profits are the profits made by firms outside of the country of their parents. So think of the profits made by Apple outside of the US, or think of the profits of BMW outside of Germany. You add up all these profits at the global levels, and what we find is that 40% of that total is booked, is shifted in tax havens today. We find that the main winners from this profit shifting, always relative to our benchmark of a perfect international tax coordination, the main winners are the tax havens like Ireland, Luxembourg, Singapore. In which sense do they benefit from the current situation? They benefit from the current situation because by attracting a huge sum of profits, $600 billion in 2015, and by applying even very low rate, even 10-year rates on this huge base, which is huge compared to their domestic economy, they managed to generate a lot of tax revenue. So that we're going to see that in the rest of this presentation. And so there is a real redistribution of tax revenues across countries, even by taxing these foreign profits at 3–5%, since they are so big compared to the size of the Irish economy or the Luxembourg economy, they do generate significant tax revenues for these countries. The main losers are always relative to our benchmark of tax coordination, or according to our estimates, the big non-haven EU countries. So think of Germany, France, Spain, and so on. A third result is we find that profit shifting quantitatively is more important, is much more important than the tax-driven mobility of tangible capital. That means that what we find is that paper profits have massively moved to low tax places, but it's much less the case that plants or headquarters or tangible capital has moved massively to low tax places. And that matters because the welfare implications of these two forms of international mobility are quite different. When tangible capital moves to low tax places, to the extent that capital and labor are complement, this reduces wages in high tax countries like the US, and this increases wages in low tax countries like Ireland, let's say. Whereas when it's just paper profits that are moving, that's irrelevant essentially for wages, for a given stock of tangible and intangible capital, whether intangible capital or whether paper profits are booked in Bermuda or in the US, that has no reason to affect productivity and wages in the different countries. And the last result that we have is that the rise of the capital share of corporate value added that's recorded in many countries, that's been studied by Brent and co-authors in particular, is even higher for high tax countries than in official statistics, because the flip side of the huge amount of profits recorded in places like Ireland and so on is that profits recorded in France, in Germany, in the US are artificially low, and so their recorded capital shares are too low. So we provide a database with corrected estimates of factor shares, day one capital shares for the corporate sector, GDP, and trade balances, corrected for this intra-group profit shifting that we estimate at the global scale. All right, so why should we care about all of this? People have widely different views about the efficiency costs of capital taxation. And let me be very clear that in this paper, we have nothing to say about that, about what's the optimal capital tax rate. We just, basically what we're doing, we're saying, look, imagine that all countries adopted the same corporate tax rate, keeping global profits, keeping the global capital stock constant. This would redistribute capital and profits across countries, and it turns out that this would have pretty important redistributive implications across countries. And we think that this matters because for a number of reasons. The fact that big multinational companies are able to shift profits to low tax places means they can pay lower effective tax rates than smaller domestic corporations, and that might distort competition. It matters also for the dynamic of inequality. So basically, some of the big winners from globalization, these big multinational companies, have seen their tax rates fall, which needs to be offset by higher tax collection on other economic actors who have not benefited as much from globalization as these big multinational companies. And this is unlikely to be very sustainable, neither economically nor politically. So I think that's the reason, whatever you think about what's the optimal capital tax rate, that's probably why we should care about these issues. All right.
Sorry to interrupt again, Gabriel. We got another Q&A from the audience. So clarifying, does the alpha measure capital or paper profits or both? And the audience wants to know, make sure that only paper profits would indicate that the firms do not behave by the rules.
Yeah, so the capital, that's a great question. So the fact that the capital share of corporate value added is extremely high in foreign firms in tax havens, in principle can reflect two things, can reflect profit shifting to tax havens, the fact that multinationals book a lot of earnings in their affiliates in low tax countries, or it can reflect the fact that affiliates in tax havens are very capital intensive and make a lot of profits because of that reason. And so I'm going to describe in what follows how we try to separate these two channels, the role of profit shifting versus the role of higher capital intensities in tax havens in explaining the high alpha in the foreign firms of tax havens. The short answer is these distorted capital shares in the foreign firms of tax havens, as a matter of principle, can reflect both profit shifting and movements of tangible capital across countries. In actual facts, one of the main findings of the paper is that essentially all of the high alpha, the totality of the high alpha of foreign firms in tax havens is due to profit shifting and not to movements of tangible capital.
Gabriel, can I, this is Hanno Lustig, by the way, can I ask you a quick question? So within the EU, I know there are strict limits on state aid to firms, for example, in the form of special regimes, but there are exceptions, for example, for regions with low GDP per capita, if I'm not mistaken. So I'm from Belgium originally. I know that in Wallonia, they've been able to attract investment by, for example, Google, because they offer special deals, and I think that's allowed. Do these sorts of things offset some of the transfers within the EU that you document? Do you have a sense of this, or do you think these are small in comparison?
So two things. So one thing that I should probably stress a bit more is at a high level. In that paper, we have nothing to say about whether what firms are doing is legal or illegal. We're just saying, look, if all countries had the same tax rate, exactly the same tax rate, here is how the geography of profits and capital would look like. And here is how it would differ compared to the geography of profits and capital that we see today. Whether the geography of profits and capital that we see today is distorted because of legal tax avoidance, tax planning, or illegal things, or transactions that are in a gray zone between legal or illegal, we have no way to identify that. And as a matter, it's very hard to identify. And in fact, conceptually, it's not even clear you can identify it in the sense that you have transactions that may be considered as illegal, but that are not going to be challenged by tax authorities. So let me take one very concrete example. In the tax laws of most countries, including the US, you have a general anti-abuse provision, which is known as economic substance, that says that any transaction which is conducted with the sole purpose of avoiding taxes is illegal. That's kind of a general economic substance clause that exists in the tax law. Now, everybody understands that when firms create subsidiaries in Bermuda, where nothing takes place, nothing of substance takes place, and move intellectual property to Bermuda, and pay billions in royalties to affiliates in Bermuda, there's no substance there. And so it's pretty clear that this is in violation of the economic substance doctrine. At the same time, these transactions have been de facto allowed, and they've not been, in many cases, challenged by tax authorities, even though, you might say, look, it really looks like there's no substance, so it's illegal. In actual fact, it's not challenged, and so it is not ruled by a court of law as being illegal. So that's just to illustrate this idea that, identifying what's legal and illegal is very hard, number one. Number two, we're not going to do that in that paper. We are not going to look at other, which I think also touches on your question. We're not going to look at other aspects of tax competition, like free trade zones, like duty-free zones. That we have nothing to say about that in that paper. We're just focusing on the particular question of the corporate income tax.
Thanks for clarifying.
Okay.
Thank you.
Okay. Let me try to accelerate a little bit. I'm talking too much. Let me, start by, let me provide a tiny bit of background on how multinationals shift profit offshore. There are three ways, basically, that firms can shift profits to low tax countries, can manipulate intragroup export and import prices. So let's say a subsidiary in Ireland is going to export at artificially high prices to an affiliate in France that's going to shift profits out of France to Ireland. Second way is through intragroup interest payments. So let's say a subsidiary in Luxembourg is going to lend money to an affiliate in the US, maybe at a high interest rate, because interest payments are deductible from the corporate income tax. It's going to reduce the tax base in the US, it's going to increase it in Luxembourg. And third, multinational firms can strategically locate intangibles in lower zero tax places. I mentioned the famous example is Google Alphabet. Just a few months before being listed in 2004, Google moved part of its intellectual property to its affiliate in Bermuda, which is a legal owner of some of the IP, and then licenses the right to use this IP to affiliates in Germany, France, all over the world, who then have to pay royalties to the Bermuda subsidiary to have the right to use some of Google's intangibles. These royalty payments reduce the tax base in European countries and increase the tax base in Bermuda, where the tax rate is 0%. So what we're doing is our estimates are going to include these three ways, these three forms of profit shifting. The previous literature on profit shifting has focused on US multinationals. There are tons of great papers. What we're doing here is we're trying to take a first global approach. And there are a few papers that try to study global profit shifting, mainly due to data issues. So let me talk very briefly about that. That may be of interest to some of you. The key database that's used to study global profits today and the activity of multinational firms in a global perspective is the Bureau van Dijk Orbis database, which is based on corporate registry data, public registries that are that exist in each country and that are collected by Bureau van Dijk and Orbis. The problem is that the tax havens either do not have public corporate registries or they have very incomplete registries, in particular with no profit information. So that if you look, for instance, in Orbis and you ask, okay, where are Google's profits in Orbis? Orbis correctly reports the global consolidated amount of profits made by Google in 2016, more than 20 billion euros. That's what's reported by Google to shareholders. But now if you want to know where these profits are booked in each country, how much are booked in the US, in Jersey, in Bermuda, in France, and you sum up all the country by country profits of Google affiliates throughout the world in Orbis, you get the pink bar. You cannot see where Google books its profits in Orbis. They're just not visible because a lot of them are in subsidiaries in tax havens like Bermuda that don't have a public corporate registry and so that don't show up in Orbis. Same thing for Apple. It's impossible to trace the location of Apple's profits in Orbis. Same thing for Facebook. When they're particularly good, you can literally trace $0 of profit of Facebook in Orbis. We just don't know where they are. And you might say, okay, that's a Silicon Valley tech thing, but you look at Nike, for instance, manufacturing, you get the same problem. So the point here is the database like Orbis is too incomplete. The data that we have are much more complete. The foreign affiliate statistics are not based on public registries. They are based on census-like confidential surveys of multinational firms in each country, harmonized definitions and guidelines. There's no double counting of profits in contrast to financial accounting data. And the main limitation of this data is that there are a number of countries that still don't publish foreign affiliate statistics, mostly Caribbean tax havens, in which case we use counterpart country data essentially to impute the profits booked by multinational firms in these Caribbean tax havens. So for instance, we know profits booked by US multinationals in the Cayman Islands, French multinationals in the Cayman Islands. By summing all of these data, we can have an estimate of how much profits are booked in the Cayman Islands overall, despite the fact that the Cayman Islands is still not reporting foreign affiliate statistics. The conceptual framework is very easy. So the key ratio we're going to be interested in is closely related to the capital share of value added, but it's slightly different. So, consider a country's corporate output Y as combining capital and effective labor. Output is paid to the owners of capital and to workers. The labor share is just, what's paid to workers divided by output. The capital share is 1 minus the labor share. Net interest paid is P% of what's paid to capital owners. The key ratio that we're interested in is the ratio of pre-tax corporate profits paid to wages paid, pi, which is just a simple transformation of the capital share. So if you forget about net interest payments, P equals 0, then pi the profits to wage ratio that we're interested in is just the capital share alpha divided by 1 minus alpha. Generally speaking, the recorded profits to wage ratio pi is a function of whether there's profit shifting or not, and tons of other economic forces that shape that determine capital shares. So let me show you, okay, so the first number one and key result is look at G7 countries, look at high tax countries, and you compute pi, the profits to wage ratio for these countries separately for local firms and foreign firms. The pink bar is the profits to wage ratio for foreign firms in Germany, so let's say affiliates of Apple in Germany, in Italy, in the UK, and so on. And the black bar is the profits to wage ratio for local firms in Germany, in Italy, in the UK. So there is a striking pattern, which is that in all of these countries, the profits to wage ratio is lower for foreign firms than for local firms. Or to put it differently, in Germany, for any euro of wage paid, local German firms, so not firms that are not an affiliate of a multinational group, book 50 cents in profits. But in Germany, foreign firms, for any euro of wage paid, they book only 20 cents in profits. Okay. Now I'm going to show the same graph. It's the same graph, but for tax havens. You know, on the right-hand part of the graph, you have these same countries. You know, UK, Spain, Japan, France. And on the left-hand side of the graph, I'm just adding the key tax havens. That's the key result of the paper. You see that for the tax havens, it's exactly the opposite. Foreign firms have much higher profits to wage ratio than local firms, and really much, much higher. So for Ireland, for any euro of wage paid in a foreign firm in Ireland, 8 euros in profits are booked. In Puerto Rico, for any dollar of wage paid by foreign firms, mostly American multinationals, US multinationals operating in Puerto Rico, for the purpose of the corporate tax, you know, Puerto Rico is a separate country than is separate from the US. For any dollar of wage paid in Puerto Rico, US multinationals report close to $17 in profits. Okay, and so once you've seen this graph, you know, it pretty much summarizes the key empirical results and the estimation strategy, the empirical procedure. Because what we're going to do next is we're just going to say for each tax haven, we're going to equate, we're going to say if there was a perfect international tax coordination, the pink bar will be equal to the black bar. Okay, and we're going to say all of the excess of the pink bar above and beyond the black bar in tax havens reflects either profit shifting or higher capital intensities in these tax havens. Okay, so I've just summarized that slide here. Let me just move to explain how we are going to separate what fraction of the excess of the pink bar over the black bar reflects profit shifting versus higher capital intensities. So imagine that tax havens attract highly capital intensive industries, and there is a bit of that, you know, for instance, in Ireland. If production is Scott Douglas, as we all know, this does not affect, capital intensity doesn't affect labor and capital shares. And so higher capital intensities cannot explain any of the relatively high profits to wage ratio of foreign firms in Ireland. That's in the case when the elasticity of substitution between capital and labor is equal to 1. Higher capital intensities are perfectly offset by lower marginal products of capital, such that factor shares, hence our pi ratio is unaffected by differences in capital intensities. So for higher capital intensities to explain the high profits to wage ratio of tax havens, it has to be that the elasticity of substitution, sigma, is higher than 1. And so by making assumptions about sigma, basically you can identify what fraction of the relatively high pi of tax havens is due to capital intensity, higher capital intensities versus profit shifting. The main point, however, is that in practice, the value of sigma is not going to matter much, because it turns out that overall, and although there is some heterogeneity across tax havens, affiliates in tax havens are not much more capital intensive, or not significantly more capital intensive capital intensive than affiliates in high tax countries. I'm going to show that graph, and then I'm going to conclude to leave time for questions. But that is a pretty striking graph, I think, focusing on the case of US multinationals. So we take US multinationals and we partition their affiliates in two groups. They have affiliates in tax havens and they have affiliates in non-haven countries. What this graph here shows is that 90%, 100% of the wage bill of paid by US multinationals abroad is paid by the non-haven affiliates. Okay, so mostly US multinationals employ people in Canada, in the UK, in Japan, in Germany, and close to 100% of the wage bill is paid in those countries. Okay, you can contrast that with tangible capital, and you see a somewhat similar, a pretty similar picture, namely close to 90% of the stock of tangible capital of US multinationals is in high tax countries. Only about 10–15% in recent years is in countries like Ireland, Switzerland, Singapore, the Caribbean havens, and so on. You can see that the share of the tangible capital stock that's held in tax havens is rising, and is rising faster than the wage bill, which means that there is some evidence that US multinationals have moved some of their more capital-intensive activities to tax havens. But this is very modest compared to the scale of profit shifting. Here I'm just adding the share of their foreign profits that US multinationals booked in tax havens versus non-haven countries. So basically they have 10–15% of their capital stock in tax havens. They pay 5–10% of their wages in tax havens, but they book 50% of their profits in tax havens. And because the capital intensity is not enormously higher in tax havens than in non-haven countries, whatever assumption we make about sigma is not about the elasticity of substitution with capital and labor, is not going to matter quantitatively for our estimates of how much profits are shifted, paper profits are shifted to tax havens. That's just the last graph. Sometimes people say—
Gabriel, sorry to interrupt before you move on to the next graph. Quick clarifying question. Do you have bilateral flows for the profit shifting? Like, do you know how much profits are shifting, say, from Italy to the Netherlands?
Correct. Yes, absolutely. You can see we have bilateral estimates. You can see our estimates on the website, missingprofits.world. You can go on missingprofits.world, click on Italy, and that's the graph I showed at the beginning for Spain. You click on Italy and you're going to have a table like that that gives you the total amount of profits shifted here out of Spain, 15 billion, and how much is shifted to EU havens, close to 12 billion, Belgium, 1 billion, and so on. And so we have that table for each country. Okay, so I had way too much material. Let me just finish with that graph and then I'll conclude and then we can discuss. Sometimes there is a view that what has happened is that firms, US multinationals, what they've done is it's not that they've moved their tangible capital to Ireland, but it's that they are now producing intangible capital in tax havens. So it's not profit shifting, is now, the IP, the intangible capital is produced in tax havens directly. However, that's not true, and when you look at the data on the foreign affiliate statistics of the US, what you can see is that more than 90% of the employees engaged in R&D by foreign affiliates of US multinationals are in non-haven countries. They are in the UK, they are in Japan, they are not in Ireland, they are not in Switzerland. And so the profits that are booked in these tax havens have been shifted essentially from the rest of the world. Okay, I had way too much material. Let me just conclude by saying, repeating our main finding that about 40% of multinational profits are shifted to tax havens. Paper profits move a lot, tangible capital less so. Non-haven EU governments appear to be the main users in terms of corporate income tax revenues. I didn't have the time to show these results, but we can decompose the amount of profits shifted to tax havens with the 40% number by country of the parent. And so what we find is that about half of the globally shifted profits are shifted by US multinationals. And so their shifting intensity is higher. So for the world as a whole, multinational companies shift about 40% of their multinational profits. For US multinationals, it's about 55, 60%. Tax competition has large redistributive effects, but these effects are different than in the textbook model of tax competition. The textbook model of tax competition emphasizes tax competition for tangible capital with effects on wages. What we find is that the type of tax competition that exists today is mostly tax competition for paper profits with by definition, no effect on wages, but with sizable effects on tax collection, and the rise of the global capital share, of the corporate global capital share, especially in high tax countries since the 1980s, is higher than the official data. Just to put one number on that, if you look at continental European countries, by our estimate, the rise in the corporate capital share in those countries, once you correct the capital share for profit shifting, is twice as large in reality as in the official data. All right, and I'll stop here, and I look forward to your questions. Thank you very much.
Great, thank you so much. So now we're opening the floor for Q&As. We already have a few questions lined up, but please also feel free to continue typing questions in the Q&A feature. So first, Jesse Schrager, you want to ask your question?
Great. So hey, Gabriel. So I think this is a really interesting paper. So I was wondering if you had any thoughts on what incentives firms would have to book profits in one tax haven versus another one. So why would you choose to go to Ireland versus Bermuda? And is that kind of something that would vary by where the multinational is based or any other characteristic?
Yeah, that's a great question. And I can't say I have a very good answer to that question. We do see some geographical patterns. That is, we see that European multinationals are more likely to use EU tax havens, perhaps because EU regulations make it easier to move profits within the European Union. So typically, intra-group payments of dividends are not taxable when these are payments between two EU countries. By contrast, we tend to see that US multinationals use Caribbean tax havens more extensively. Might be due to, again, that might be due to geography, historical reasons. We see that, we see these patterns in the data, but that's something that would deserve to be studied more, more extensively.
Great. Now we have Brent Neiman. Brent, can you unmute yourself? Yeah.
Yep. Sorry about that. I thought this was really cool work, Gabriel. Really nice talk. Two quick, semi-clarifying questions. One was I just wanted to make sure I understood. Toward the end, you were talking about the implied, if I got it right, under measurement of the rise of global capital share. But I kind of wanted to understand essentially where the reallocated capital income toward, let's say, those European countries comes. I thought it came from, tax havens, which would have a mismeasured GDP, such that the true global capital share, if you actually measured it using all countries in the world, I thought would be unaffected, and instead your statement would apply to those rich countries that I agree typically are considered the sort of global drivers of it. And then very quickly, I think it's kind of related. I wanted to understand, I understood how you were arguing that, or measuring, showing that foreign firms and tax havens had a much, much higher capital share. The fact that they have a much, much lower capital share in non-tax havens, should I think of that as simply the, the offsetting, the complement to make it all add up? Or is there something even above and beyond that? Thank you.
Yeah, and these are two great questions. Let me start with the second question, which is referring to this graph here. So the fact that foreign firms in tax havens are less profitable than, that foreign firms in non-haven countries are less profitable than local firms in non-haven countries reflects both the fact that there is outward profit shifting out of Germany, out of Italy, and other factors. Could be due to the fact that foreign firms are younger, for instance, than local firms. It could be due to the fact that they are in other sectors of the economy that might be less profitable. What we are doing in that research, we're not trying to say what fraction of the difference between the pink bar and the black bar for non-haven countries reflects outward profit shifting. It's a complicated question. There are a few papers about that, especially in the case of the US. The lower profitability of foreign firms has been studied quite a lot, and different factors have been put forward. So it's both due to profit shifting and other factors, and in unknown proportions. What we're saying is just for the tax havens, it's pretty clear that the huge excess of the pink bar over the black bar that reflects inward profit shifting to tax havens. And then for your question on the global capital share, my slide was poorly phrased, is the rise of the global high tax countries' capital share is underestimated. You're absolutely right that if we had, complete data for absolutely all countries, the fact that there is a higher capital share in France or in Germany would be perfectly offset by a lower capital share in Bermuda, in the Cayman Islands, Ireland, and so on. Typically, in most databases of factor shares, you don't have the tax havens, or at least sometimes you have Ireland and Netherlands, but you don't have all the tax havens.
Got it. Got it. It's a shift of capital income from the tax havens to the non-tax havens that you're getting. Got it. Thank you.
Two pretty different. So one thing that's striking is one thing you can see in our data is you can see how Ireland, the national accounts of Ireland would look like if you try to purge them from profit shifting, and you see, the GDP would be like 25–30% lower. Capital share would be much lower. Ireland also has a huge trade surplus of something like 30% of GDP, which is also largely due to basically to profit shifting. And so you can see in the case of Ireland how correcting the data makes a huge difference, and difference in the other direction for high tax countries.
Great, thanks. Now we have Linda Goldberg.
Hi, can you hear me?
Yes.
Yes. Okay. So really interesting work. I could see how you're getting the results about underestimated capital levels. But when you're going to do specific comparisons across countries or get specific country numbers, how much do you have to rely on similar production structures being in place across countries? So the labor capital share by sector being similar. And then I guess I also had a thought in response to Jesse's question about which tax haven. And here I just want to note that in work that I've done on US bank holding companies, I've looked at how their affiliate structures have changed vis-a-vis favorable tax locations and vis-a-vis financial secrecy locations. Historically, both of those mattered. In the post-global financial crisis period, the affiliates in poorly ranked secrecy locations have come down, whereas the favorable tax locations have remained stable. So there might be other dimensions of what you're choosing for locating your kind of affiliates.
Yeah, absolutely. No, that's very important. Regarding your first question, so let me try to put the slides again. So basically, yeah, let me use this this question to talk about to give a bit more details about the robustness, if you want, of the estimation strategy with respect to several concerns that you might have. So the benchmark estimation is you take the tax havens for which the pink bar here is higher than the black bar, you equate the pink bar to the black bar, that's the estimate of how much profits are shifted to those countries. You might say, okay, there are potentially a number of issues with that. There is one issue that you've alluded to is maybe foreign firms in tax havens are different than local firms because of different sectoral composition. So maybe the foreign firms in tax havens, they are all in highly profitable sectors as opposed to local firms. What's nice with the foreign affiliate statistics is that you can do the exercise that we did, comparing the labor and capital share of foreign firms and local firms within each country by sector. And basically, you find the same pattern when you do this by sector. So here it's focusing on the case of US multinationals. That's the profits to wage ratio of the affiliates of US multinationals abroad in tax havens, the pink bar, versus non-haven countries, the blue bar, by sector. And so you can see that for each sector, you have basically an order of magnitude difference in profitability. So chemical industry, the affiliates in the UK or in Germany have a profits to wage ratio of a bit less than 1. The affiliates in tax havens have a profits to wage ratio of about 4.5. Same for computers, wholesale trade, information, finance, and others. So it's not all due, it's essentially not due to differences in sectoral composition, and we quantify that more precisely in the paper. Another concern that you might have is when you look at this graph, the pink, profitability of foreign firms in havens much higher than the profitability of local firms in havens. You might say, well, okay, but there's a problem here, which is that maybe the black bar itself in tax havens is inflated. So let's take the case of an Irish, let's take the case of a US company that has inverted to Ireland. There's been a number of cases a few years ago. Now this company is an Irish company, and so its profits to wage ratio is part of the black bar in Ireland. So you could say, actually, we are underestimating how much profits are being shifted to Ireland because the benchmark itself is inflated by profit shifting. But as you can see on that graph, the black bar in Ireland, profitability of local Irish firms is only slightly higher than in other countries. And so even if you reduce it a little bit, and we do that computation in the paper, that the quantitative impact on our estimates is quite small. Okay, so these are two the two kind of main limitations with this basic, very simple estimation procedure. And in practice, the results don't change a lot when you account for sectoral composition or when you account for profitability of local firms in tax havens being inflated by inward profit shifting.
Great, thank you. Now we have Jin Yang to ask a question.
Hi, this is Jin Yang. Very nice talk, and thanks for agreeing to present here. My question is about the composition within the foreign firms. So I understand it's hard to get data at the firm level, but is there any reason to believe that financial versus industrial foreign firms will have very different behavior at tax havens, for example, in their profitability or flows?
Yeah, that's a good question, and there is a bit of evidence of on the graph that I showed on sectoral composition. If you see the graph, you can see here for the financial, for the affiliates of U.S. multinationals in the finance industry, they are the firms that have the highest profits to wage ratio in tax havens. So yes, in finance, it is quite simple to book earnings in low tax places. You can move, loans and portfolios of securities. You can book them in affiliates in lower zero tax places and earn income in those countries. You see evidence of this very clearly in the statistics from the Bank for International Settlements, where a lot of bank lending at the global level is done by affiliates of big banks located in tax havens, in particular in the Cayman Islands. And so that's the reason why for the finance industry, you have this very high ratio of profits to wage in haven affiliates. But you can also see on the graph that this pattern of an order of magnitude difference between profits to wage ratio in high tax versus low tax countries. This pattern is is also here in the other industries.
Great, thank you. Now I have Christian to ask a question.
Hello, thank you very much for your very interesting talk. You emphasized the shifting of intangible assets, but you gave the Google example. My understanding is this would not necessarily be a tax problem if Google US charged the right price to Google Bermudas for the intangible assets. So do you have any evidence that multinationals are able to charge low prices below the fair market value when they sell to tax haven subsidiaries?
Yes, that is a very good question, and you're absolutely right that in principle there's no tax saving if the firm, when it sells its IP, sells it at the relevant current market price and pay taxes on that. So we are trying to collect. That's something that didn't have the time to present, but we are trying to collect systematic data on how much. On how much taxes, that's on that slide here, how much taxes are collected by countries at the time of the transfer of the IP. There is also, sometimes even when the IP is shifted to a tax haven, countries have rules to keep taxing the income generated by that intellectual property, so rules known as the taxation of passive income or controlled foreign corporation rules. And so we are collecting data on that to estimate how much these backstop rules, matter, and whether they work in generating tax revenue in the US and similar countries. In the case of Google, Alphabet, in most cases, when there is a transfer of IP, the way it works is as follows. The IP is transferred just before the firms go public. So in the case of Google, it was 6 months, 1 year before being listed as a public company. And the reason why they do that is because as long as you're not listed, it's relatively easy to pretend that your core technology, your IP, is not worth a lot. In the famous leak of documents from PwC, LuxLeaks, that occurred in 2015, you could see that in some of the most famous cases of IP transfer, for instance, Skype moving its intellectual property just before being bought back by Microsoft, the price that was charged at the time of the transfer was almost zero. in the case of Skype, the price was something like 10,000 euros for that IP. And then Skype a few months later was bought by Microsoft for several billion dollars. In the case of Alphabet, in the case of Google, if they had charged a high price for their IP in 2003 when they transferred it to Bermuda, they should have paid a lot of taxes in the US, but you can see, in the SEC filings of Google for 2003 that they didn't pay much tax globally in 2003. They paid a negligible amount of tax, and so it's not consistent with the hypothesis that they charge a high price on that IP. It's pretty clear in that case that they were able to sell it for a very low price. But these are just anecdotal evidence. There's no public information on the price at which intellectual property is sold, within divisions of a multinational company, and so it's hard to come up with a good quantitative answer to that question.
Great, thank you. Next, we have Lorenz to ask a question.
Hi, Gabriel. Thanks a lot for the interesting talk and the nice presentation. I was just wondering if you could say a bit more about the two key data sources that you're using and for how many countries your estimates are currently already available and for how many years.
Yeah, so our estimates are available for all countries because we systematically imputed data when no data was available. So, so the countries that have foreign affiliates statistics of that type here, essentially all the OECD tax havens now have foreign affiliate statistics. That includes Ireland, Luxembourg, the Netherlands, Switzerland. A number of non-OECD tax havens also have foreign affiliates statistics. There is some information, for instance, for Singapore, for Hong Kong. The main gap is the Caribbean tax havens, like the Cayman Islands, Bermuda. They don't have foreign affiliate statistics, but what's important to realize is that the foreign affiliate statistics that exist are both inward and outward. So, for instance, a country like France is going to have inward foreign affiliate statistics, which means the decompositions of the value added and profits and wages made by foreign firms in France, but also outward foreign affiliate statistics, the decomposition of value added, wages, profits made by the affiliates of French multinationals in foreign countries by country, including, in some cases, fine breakdowns by, where you see places like the Cayman Islands and these Caribbean tax havens. And so the way that we fill in the gaps in the database, we reconstruct inward foreign affiliate statistics for places like the Cayman Islands using the outward counterpart country data, the outward foreign affiliate statistics of the US and of the other countries that have outward foreign affiliate statistics.
Great, thank you. Yeah, next we have Jana to ask a question.
Yes, good morning. Thank you so much for this fantastic presentation. I think you have partially answered my question because, while answering to somebody else's question, but I still maybe like to hear more about it. I was wondering if you could comment on the importance of tax havens in multinational bank activity. Do we observe the same patterns concerning the missing profits that you described previously in multinational banking, or is the situation different in multinational banking from multinational activities in industrial sectors?
That's an important question. I think, yes, the evidence that exists on the financial sector and banking is also consistent with the view that there is, that the financial sector, the banking sector uses tax havens quite significantly. The way that it works for the banking industry is different than other sectors. So in other sectors, what happens is profits are shifted by using sometimes intra-group imports and exports. Like, I don't know, to take an example, a company is going to export computers out of Ireland at an artificially high price to a related firm in France. There's going to be shifting of intangibles, like in the case of Google that I mentioned. For the financial industry, the intangibles that are booked in tax havens are not intellectual property or algorithms or logos or things like that, but they are portfolios of financial securities, equities and bonds, for trading, and portfolios of loans. So again, if you look at the statistics from the Bank for International Settlements on cross-border lending, you can see, by nationality, you can see US banks have affiliates in the Cayman Islands, which then lend money to places, to corporations and governments all over the world. That generates income in the Cayman Islands, which sometimes is taxable and taxed in the US, and sometimes is not taxed, depending on these rules about controlled foreign corporation that I briefly alluded to, but which have been significantly weakened in recent years and decades. So the short answer is yes, this is something that happens in the banking sector with slightly different mechanisms than other sectors.
Great. I think we have cleared all the questions, and thank you so much again, Gabriel, and thank you, everybody. Yeah, we look forward to seeing you in 2 weeks.
Thank you.